There have been sporadic bounces that one has seen, but how is it that we should read into that? Is this a long-term story which is now underway for IT, and whether there is there is merit in actually buying these stocks for the longer term? We've got Ravi Menon, analyst IT and Technology India at Macquarie, joining in on the show right now to talk about exactly that. Ravi, hi, morning. Good to have you on the show. You've got an outperform on HCL, on Tech Mahindra, on TCS. What's giving you conviction right now that these stocks, after the kind of massive underperformance that has played out, are finally going to be in the limelight?
Morning, Aisha. Thanks for having me. Slight correction. I have an underperform on Tech Mahindra, but we have an outperform on TCS, on HCL, Wipro, LTI Mindtree, neutral on Infosys. We think that the sector actually has a really strong run ahead. We think this is the largest tech refresh that we're seeing in enterprise technology since the 2000s. We are still in early stages of that. So I think long term, the outlook remains pretty good. I think that consensus has still been looking at what happened during COVID as really a one-off. I don't agree with that. I think that we have seen a significant change in consumer behavior during COVID. Your wealthier cohorts of customers, older cohort, generally they tend to be the same in the developed markets. They have started engaging with companies more online, and that's the need for digital transformation. So we think that there is going to be significant investments also in trying to modernize data landscapes to prepare for AI. And since that's a one-time activity, it's perfect for outsourcing. We should see a lot of demand for all that.
Okay, so there is demand which is going to come back. Ravi, hi, this is Anisha also joining in the conversation. But which nature of clients will come back with the spend in the fastest way? Is it going to be BFSI? Is it going to be auto-related? Is it going to be ER&D or telecom? Any specific vertical that you're watching out for that might just come back quicker versus the rest?
I think BFSI, Anisha, I think that should be the quickest. Telecom, I'm not really hopeful about because you've seen the 5G spends not really deliver ARPU uplift all over the world. So that's a sector that I think is in trouble. That's part of the reason why we are negative Tech Mahindra. We think third of the portfolio is telecom. If your customers are in trouble, very difficult for you to do well as a vendor there and as an incumbent with most of these. So if you look at automotive, again, you're seeing people actually cutting back on ER&D spending there. Carrier, Volkswagen's software announced 1,400 people layoff. GM has announced 1,000 people layoff. So I think people are perhaps reacting to either the EV inventory buildup or they think that they've overinvested in the software side. I'm not sure what. I'm not an auto analyst, but I'm just looking at the news flow. Doesn't seem to be encouraging. So I would expect auto to be probably one of the sectors that comes back later.
In your recent notes on the likes of a TCS, HCL, etc., you've mentioned that you actually see the legacy business and legacy clients to make a comeback and AI not be such a threat. When the underperformance for the entire IT sector began, everyone really questioned as to in this era of AI, whether these traditional businesses, IT services that is, are going to be worthwhile at all or not. How is it that now AI fits into the piece of scheme of things?
So a lot of large enterprises, right? They cannot. It's just like when open source came out, but you can't just adopt something that's out there or that's auto-generated. You don't know if there are intellectual property violations. A Fortune 500 company cannot actually just take code without actually running it through their standards to make sure that there is no IP violation. There are no security, rabbit holes that people can access, exploit. So there are coding standards that they follow. So AI can only do so much. And besides, the whole software in the whole software development process, coding and testing is only 40% of the effort. And there, yes, there is productivity benefit. But even there, we think it will be 10, 20%. So for overall, it's not really dramatic. And we are seeing, in fact, that might even aid. So TCS, for example, showed us a legacy modernization solution they've created using AI, where you can parse through old mainframe code, map it into functionality, and use AI again to generate code in any new technology you want. So that speeds up the whole process. I think that's a very compelling value proposition. And earlier people wouldn't sign off on some of this because it would take as long as 10 years. And now if it can be done in 2 or 3, yeah, I think then there is a good business case for legacy modernization.
Point taken, but I just wanted to get a sense from you, Ravi. Would you be more interested in looking at the second tier IT companies and the niche IT players, or do you think the large caps, the TCS and HCL Tech of the world provide better comfort?
Yeah, that's a very good question. I think that the mid caps might grow faster, and I'm not saying all of them. Some of them will. Persistent Systems is the firm that we expect to grow fastest in the sector. We're looking at 20% plus growth for next year from Persistent. But I still think the large caps provide more comfort in terms of valuation. HCL Tech, TCS, both. TCS is our top pick now in the sector. HCL Tech is number 2. If you take a 3-year view with like HCL Tech, because we think that will grow a little faster than TCS and has margin upside as well. So that's how we view it. The mid caps Persistent compounding is going to be faster, but you're of course paying a premium for that. So if there is a sector derating, that is the risk that you carry when you buy the mid caps.
Okay, and what's the pecking order within the mid caps? Would you mind repeating that? I missed that if you said that.
No, I hadn't said that. So Persistent Systems are topic, which is outperform rated. Coforge, we are neutral on, considering the Signity acquisition. We think it'll take some time for that merger to take place. So we're a bit cautious there. Most of the others we are actually underperformed. So Emphasis we are an underperform. LTTS we are an underperform because we think engineering services overall will grow slower than IT services, and we are worried about the valuation there for these firms. Otherwise, like the firm, a really strong portfolio and all that, but it's just on valuations that we have discomfort with. And the small caps, we like Birlasoft and Mastech. Birlasoft, we prefer over Mastech, given the portfolio and the recent CEO change at Mastech. I think we still haven't seen a permanent CEO come in at Mastech.
So Mastech, Birlasoft from the small cap category is something that you like, but yes, valuations in some of these stocks is something that you need to watch out for. Ravi, what's your expectation of the recovery? That was where we began the conversation with. Do you think after the US election is perhaps out of the way, we'll see a sharp bounce back in the second half of the year itself? Or do you think this is going to be a more FY26, FY27 kind of story? Because you see double digit coming back in FY26 itself is another question.
Yeah, we expect double-digit growth in FY26, and we think actually it's more linked to the Fed rate cut rather than the election. And they happen to coincide now, but new client budgets that will start in January. I think before that, if we can get a rate cut, which now seems to be likely, I think most of the Fed seems to be talking about a rate cut in September if they have an agreement on that. I think that will be the beginning when people get confidence that the US economy is not going into a recession, and they'll have confidence in their ability to spend. So we would expect that next year IT budgets are healthier.
Okay, IT budgets are likely to be healthier next year, but what about the margin picture? Because on one hand, those attrition pressures, etc., had abated, but now pricing is also looking like a bit of a challenge because all of these companies are fighting for these deals, and the deal wins, however, have been pretty okay. They haven't been as bad as the headlines kind of come through. Do you think because of the pricing pressure, there could be a bit of a dip on margins, or do you expect them to hold on?
In fact, that's a really good point. In fact, pricing like to like is seeing an upward movement according to deal advisory firm ISG. So there is no pricing pressure. Prices are actually trending up, if anything, because I think clients are adjusting to the wage inflation that we saw in India. So during COVID, and new deals are being struck at slightly better price points. So I don't think there is a pricing pressure. And once we have growth back in double digits, I think with 8% plus growth itself, holding on to margins will be easy. If you have 10% plus growth, then I think margin expansion is also possible, and that's what we expect next year.
Ravi, good to have you on the show. Thanks as always for joining in with your take on where the prospects of IT are headed.
Yeah, thanks for having me.
If you like this video, then like, share and subscribe to ET Now.